Hello everyone, welcome back for another episode. After stock market huge leap, will stock pull back? What were behind the immense move? Betting Fed's pivot? Recent dollar weakening? Treasury yield drop? It's easy to read into very high two-way volatility across assets as signaling a Fed pivot is finally here, but we just haven't seen any reason for that until the Fed durably shifts away from their concern over inflation. Headwinds for stocks and bonds alongside tailwinds for the dollar will continue. All leading indices and stocks rebound sharply, mainly due to largely oversold conditions. U.S. stocks are trading up this week as Treasury yields fall and the soaring U.S. dollar loses some of its strength. The market moves come as investors look for any hints that the Federal Reserve might back off from its aggressive tightening of monetary policy. On Monday, markets benefited from huge delchinis in yields, dropped 15.2 basis points. Treasury yields continued to dip on Tuesday. The ICE US dollar index, a measure of the dollar's strength against a basket of rival currencies, was down more than 1% around midday Tuesday. The U.S. stock market was moving sharply higher again on Tuesday, with the Dow Jones Industrial Average DXY plus 2.80% jumping 2.6%, the S&P 500 SPX, as FinViz map is almost green. Stocks leaped. S&P increased 5% last two trading days. Stocks, SPY, QQQ and Dow ETF all turned around. S&P 500 ETF SPY is well above its 200 weekly EMA, QQQ and DIA across their 200 weekly EMA as well. Ten-year minus two-year Treasury and updated chart to October 4, 22 are largely inversed. After this week, stock market lead, the multiplier is close to 17 now. Is the stock market ready to climb further higher, or it will pull back? Let's another indicator Shiller PE ratio. Stocks are still relatively richly valued based on a popular measure of cyclically adjusted equity valuations. Instead of using forward earnings expectations or trailing 12-month earnings, the Shiller ratio is based on the inflation-adjusted average of corporate earnings over the past 10 years. According to the Shiller PE ratio, the long-run mean valuation for stocks dating back to the 1870s is between 16 times and 17 times cyclically adjusted earnings. As of Friday, the S&P 500, which was created in 1957, was trading at 27.5 times earnings, and after Monday's rally, it was trading at 28.2 times. In the previous episode, we looked CPI data based on three modelings. That it remains sticky. Let's see more details. The Cleveland Fed's NOWCAST showing CPI September is 8.2%, which is the same as the last CPI August, and core inflation month over month increased slightly, which is not a good sign for Fed to pivot. Let's review the leading ETFs QQQ, S&P 500 SPY, Dow Industrial DIA. QQQ reached 20D EMA. So do SPY and DIA reach their 20-day moving average. AAPL increased 6.5% in the past two trading days. It is still below the 20-day moving average. Microsoft increased almost 7% this week, and it is above its 20 days moving average. Google increased this 2 trading days 7% and reached the 20 days moving average. Tesla was really weak due to its miss of delivery and also the Twitter deal. NVDA had a large move up and reached its 20 days moving average as well. Goldman Sachs had a huge up move over 8%. It crossed its 20 days moving average. Tuesday alone it increased over 5%. XLE Energy ETF, XLF Financial ETF and XLV Healthcare ETF and XLI Industrial had their large advance and well above their 20 days moving average. The latest advance for stocks could signal more pain ahead for the MSFT. As tempting as it might be to call a bottom in stock, that investors should brace for more carnage in the near term as several reliable historical signs of a durable bottom are still missing from markets. Valuations are still too high, and although 2022 has seen immense two-way volatility in stocks, sharp moves higher historically tend to signal that more volatility might be in store for stocks. The second is that the recent dollar DXY strength also supports a higher severe recession probability. Importantly, while we are aware that a stronger dollar will have a negative translation impact on U.S. corporate earnings, that does not overly concern us. Rather, it is the potential impact of a structurally higher for longer USD that may weigh on many business models as global growth comes under further pressure. Let's look SPY open interest maximum pain chart. And we will look more details about CPI September forecast on the next video. Thank you, see you at next episode, and hope you have great stock trade tomorrow.